First and foremost, MicroStrategy's future is tied to Bitcoin. And I'm confident Bitcoin's price will recover because Bitcoin still remains one of the most pristine ways to transfer and store value. It is a blockchain that has never been exploited. And it's supported by a community that wants to ossify and protect that chain.
Over the past few months, the crypto market has been caught in a relentless downturn, shaking confidence and leaving many investors wondering if the bull market is quietly slipping away. Every dip has fueled more fear, and every headline seems to suggest that the worst is still ahead. But what if that's exactly when the biggest opportunities begin to emerge? In this interview, Tom Lee challenges the growing pessimism surrounding Bitcoin and breaks down why he believes the market is missing the bigger picture. He also weighs in on Michael Saylor's strategy, explaining why the recent weakness in MSTR and STRC may not be the disaster many fear. According to Lee, if Bitcoin recovers, these companies are positioned to recover with it. So, is today's fear justified, or are investors about to be caught off guard by what comes next? Let's dive into Tom Lee's insights.
So I think as long as Bitcoin's price recovers, strategy is going to stage a big recovery in its entire stack of pref and convertibles and debt. But as we know, markets are like war. And imagine like a formation of B-17 bombers flying over Germany, okay? And there's a plane that's falling a little behind. That's who the fighters are going to attack and try to take down. And so I think investors are viewing Strategy's public capital structure, which is available to public markets, right? It's not like someone can go and exploit the Bitcoin blockchain, and they're going to test his capital structure. So I think that's the test he's facing right now. And I think that the best defense for him is to be raising and increasing his cash balance, because that raising cash provides a cushion to the entire cap stack. So if I was Michael Saylor, I would probably think that MSTR and raising cash through selling the common might be the best strategy, but I'm not Michael Saylor. And but when I look at the cap structure, as you know, that adding a cash cushion or adding more equity to the cap structure is really what protects that fleet. And so I would say, to me, anything they can do to either increase the dollar amount of the equity cushion or the amount of cash is really makes the most sense. Crypto, I think, is not really a broken story, but it is going to have price lagging in the near term because the fundamental story is compounding, and crypto is still a really important downstream story to AI. I mean, I think that's really hasn't changed, and Wall Street has an outdated tech stack that they want to upgrade, and that is going to be built on crypto rails. That story hasn't changed. So to me, when I look 2 years out, I think the future is still, we're tracking towards it. Very important future, or that's very crypto centric, but price doesn't have to respond today because, it's easier to buy the bottlenecks in AI.
The question every Bitcoin investor wants answered: are we still in the 4-year cycle? Tom Lee didn't hesitate. He started with first principles. Listen carefully.
Well, I think there's two things about crypto that haven't changed and that are playing out this year. One is that crypto is a hyper volatile asset. So in the scheme of things, a drawdown being 50% from a high, as you know, in Bitcoin's history, that's not even necessarily a correction. And the second is that despite crypto having a world of traders and people trading it, the best investment decisions really have required people to have a longer time frame. And that's why I think the 4-year cycle is sort of part of that, because for those that are long-term oriented and they may be tactical, then timing is important to them, because they may not want to actually be even thinking about buying crypto until we get towards that early window of the 4-year cycle. So that's really, August to October. And then in people's minds, that's prices, it may be 50 or 60,000. I think that's really, a question for an investor, like for someone who's new to crypto, because they may be used to quarterly announcements, specific catalysts. But in the history of crypto, we know that not only is it hyper volatile and it's decentralized, so there's no quote announcements, but we also know that crypto makes most of its gains in 10 days. So the 10 best days drive almost all the returns in a year. So if someone's trying to time their Bitcoin buys, if they've got a great model, I think it's going to, that could serve them very well. But keep in mind, Bitcoin has the best compounded annual return of any asset over the past 10 years or even the past 15 years. But what's interesting is if you exclude the 10 best days for each year in Bitcoin, you'd actually be down 27% per year. So all the gains in Bitcoin basically come down to 10 days.
Why do you think that is, Tom?
Well, I think that's actually, in general, the idea of 10 days accounting for all the gains is, the idea of, the mistake of timing markets. That's also true in the stock market. We've published this stat. Since 1929, the S&P has compounded at roughly 9% a year. If you miss the 10 best days, your return, and this is going to shock you, drops to negative. I believe the 10 best days average in the S&P 2,100 basis points, meaning your return drops to negative 10% a year. That's probably why the average person doesn't really beat the market, because they're trying to time it. And if someone just buys the S&P and holds it, they're going to compound at 9% a year. So, and in fact, in the last 3 years, the 10 best days have been a bigger driver. It's been over 24 percentage points. So last year, you would have had a negative double-digit year if you did not stay invested the whole year. I think Ethereum can't escape the fact that we're in a period where price is lagging fundamentals. Ethereum has gained additional assets, so more real-world assets are being tokenized on Ethereum. Ethereum, the foundation, is now upgrading and making Ethereum quantum-proof, adding privacy, all the things that are going to be future-proofing Ethereum. And I think if someone questions, do we need decentralized blockchains in the future? We already know what Wall Street's doing. They are tokenizing. Most of the major funds and stocks that are being tokenized on Ethereum because it is the most widely used blockchain. And I think for someone who's really thinking about AI, they need to keep in mind that in the AI world, a lot of those engineers are also realizing that downstream of the AI story is a need to really prove identity and decentralized control. And I'll give you an example. It's probably not going to be too many years away when AI agents are going to be producing income for us. They are going to be our delegated entities, and they'll be earning income, accumulating wealth. AI agents might actually become wealthier than us. In other words, we're going to start to question whether we work for the AI agent or they actually work for us. And if it's a centralized system, then you end up with Skynet. That's why I think there's going to be a real focus on people relying on decentralized systems to protect humans against AI becoming too powerful. So I would say, there is no change to the idea that at the center of why you want to be involved in crypto is both the future of AI and Wall Street's updating their tech stacks. But yeah, it's been no fun. This has not been a summer of crypto. Price has been terrible.
What would it be that would make you a Bitmine bear? What would it be that would have to happen that would change your thesis on Ethereum and or Bitmine?
Well, that's a good question. Today Bitmine is operating in the mode that it is crypto winter spring. I'd say more spring. And that's why we've operated with a very conservative capital structure. The company keeps a very large cash position of about $600 million of cash. And we've staked, about 80% of the Ethereum, and that's generating over $250 million a year in staking rewards. So the company has free cash flow of several $100 million a year and a huge cash cushion available, and has been making selective investments. I think we've disclosed our investment in Mr. Beast and in 8Co. And we are working very closely with the spin-off entities that have left the Ethereum Foundation, including ETH Labs. I think there's going to be several more entities announcing funding soon. And we are taking a very proactive role. We are working with entities like SharpLink and Joe Lubin and many of the core developers of Ethereum to not only strengthen and fund and grant the right sort of public goods within Ethereum, but we're also helping improve enterprise engagement and also do a lot of what I call forward deployment around AI. So I feel very confident that when crypto winter, spring ends and the bull market starts, that Ethereum is going to be a central player in all things that are going to be very relevant. And, in that future, financial services, the whole industry is really becoming a tech stack. Money is becoming software. And when you move money and make it software and composable, there is a transformation of the economy. And that's really where Ethereum is going to shine, because now all of a sudden stocks trade 24/7, but stocks trade on factors. I think there's an enormous opportunity. But yes, we are in a period where price is really disappointing, and it's very frustrating as well.
One of the hardest parts of investing isn't surviving a bear market, it's surviving your own emotions. When Tom Lee was asked about the biggest psychological strategy that keeps him calm while everyone else is panicking, his answer wasn't about charts or predictions. It came from years of painful experience and hard-earned lessons. If you've ever questioned your conviction during a market crash, listen very carefully to what he says next.
I've experienced this before. I think what really has prepared me is, I've spent more than 35 years on Wall Street. And of those, I spent 17 years covering the wireless industry. And to me, those first 17 years really taught me about the difference between fundamental progress and price, because wireless stocks, subscribers grew 40% a year reliably, and tech spend and telecom capex and the innovation around wireless and in its role was basically a parabolic rise. And yet the stocks were highly cyclical. And in fact, they faced what I consider a huge perception issue, which is people thought wireless was just a yuppie toy. They didn't see the utility and how much value it was capturing. And so I saw stocks make huge moves and stocks suffer huge drawdowns. But to me, and many of my clients know this, that's really been the big opportunities. It's during drawdowns that I'm reminded of the Japanese word for crisis, which is kiki. It's actually two words. It's danger and opportunity. People too easily focus on the danger. And in fact, that's your instinct, right? Self-preservation. But in every drawdown, you have to focus on the opportunities, because just like NVIDIA was range-bound for several years and then had a parabolic move, look at the memory stocks. They were kind of range-bound for 2 years before they exploded. And in fact, I worked at JP Morgan for 15 years. The stock was largely $17 for perhaps 13 of those 15 years. And where is JP Morgan now? Over $200. So to me, I am used to witnessing when fundamentals are compounding, price doesn't follow. So I would say We constantly test our thesis, but again, unless we are comfortable that we can trust the future of AI and let AI agents manage our wealth and our sovereignty, if we're comfortable with that, then we don't need decentralized blockchains because we can just rely on Skynet and Visa to control our future. But if we do care about that, that's why crypto is going to be extremely relevant.